On the podcast with us today is Logan Freeman and Parker Webb. Logan, Parker, welcome to the podcast. Appreciate you being here.
Thanks for having us, Dan. We're excited to be here and talk a little bit about one of our projects with you.
Awesome. And I know there's been quite the story behind this. I know we've kind of rescheduled this podcast a couple of times to make sure we got this second asset in this portfolio kind of under contract. We're really through the finish line, if you will, and getting it closed. And the name of this acquisition is the Stoneybrook Towers. It's 2 assets totaling 171 units out of Independence, Missouri, which is right outside of Kansas City. Closed the second portion of this February 26th of 2021. Before we dive into that acquisition, I want each one of you to kind of share with us and the listeners a little bit about who you are and your backgrounds and kind of where you are right now on the multifamily side of things.
Sure, I'll kick us off. So thanks again for having us, Dan. This is Logan, and I got my start in real estate by heading up a $50 million acquisition firm here in Kansas City. We were doing single family homes, but we were doing them at scale. And I finished that portfolio out around 265 doors. And what I learned after sitting down with those sponsors was a lot. I asked them where the money come from. And they said, hey, this is a syndication. Well, at that time, I had not heard that word before. I didn't know if I could even spell that word. So I went to the school. If you're watching this, you can see all the books behind me. But I started educating myself, and I started to learn that to do anything at scale, it's probably going to be a little bit easier in the multifamily and commercial sector. So I started buying a few smaller properties myself, and then figured out that in the acquisition process, in the construction and lease up, there's a lot of different operational pieces to the component that didn't really tickle my fancy, so to speak. And so I found some partners. I found some partners who had complementary skill sets that allowed us to work in our sweet spot. And so that's what we've done over the last 2 years. Parker and Corey and myself have really focused on multifamily here in the Kansas City metro area, and been working on scaling our portfolio and scaling up our employees and our company as well. So that's kind of how I got started in real estate and kind of where we're at now.
Absolutely. When I echo, thanks for having us on, Dan. So Parker Webb here. I got started in real estate brokerage world working for a big shop in Mark here in Kansas City. Started really on the investment sales side, enjoyed that work, but also was doing some consulting for public sector through the public sector consulting group, where we're, consulting cities on TIFs and CIDs and all these different resources that they can use to spur development. And that's where I really kind of got the bug for that kind of work, and focused on doing some different affordable housing projects and some others with some of my colleagues. That spurred to the principal side, where I joined a group called Midwest Retail Properties. They really focused on buying Walmart shadow anchored shopping centers. And so really buckled down hard on the retail side of things for a number of years. Did that for a bit, spun out my own shop called Third Space Property Group, which is really a brokerage management, development management company. And was, always looking for deals, but, to pay the bills, was doing a number of transactions. And so through that, found some opportunities that we wanted to buy. Logan, Corey, and I joined efforts on one of those. And then from there, we decided we wanted to keep doing business together. So that became FTW Investments, and we've been scaling ever since.
That's great. It's great to kind of see partners actually getting together, staying together long term, and actually working together. So let me ask you this in regards to the partnership. What is the key that has kept you guys together? Because I see so many partnerships that when they get together, they seem to work out for the short term, and then in the long term, they end up falling apart.
Yeah, I'll take a crack at that first. And, I do a lot of studying on this, obviously, with my favorite book is Robin Dreek's book called Sizing People Up. And he really has 6 kind of behavior predictors. Parker and Corey and myself were really focused on understanding ourselves first and being radically transparent with each other. And so, we're ruthless to the extent of self-evaluation, but I never feel like I cannot go to Parker and Corey and tell them something. We've been through some stuff over the last 24 months. I mean, some serious stuff, financially, emotionally, all of that. And I've never felt that I couldn't go talk to them. So being able to keep those lines of communication open, I know is a thread that a lot of people talk about, but it's so important. On that note too, though, we really focused on, utilizing the Colby assessment and strength finders and the Enneagram, and really trying to understand understand how we would best work together, and then focusing on, hey, this is your part of the business, this is mine, and this is yours. And staying in that sweet spot is the hard part. And that's where we're really focused on, trying to make sure that we're focused on the high value tasks that lead to the profit producing activities. But that radical transparency, ruthless evaluation, and honest feedback, which Parker is never hard to get any honest feedback, and neither am I. But so that's that thread. And I think the other thing that I would say, and I'll let Parker speak to this, but we became business partners first and then friends second. And I'm not saying that's the right way to do it, but what I have seen in my experience, that friends going into business, they have a lot of baggage. Well, we didn't really have much baggage. We were folks that respected each other and said, hey, let's go do some projects together. And then if we like that, let's go talk about what that looks like long term. So we kind of took that strategy instead of becoming friends first as well.
Yeah, I would agree with all that and echo. I think, we genuinely like each other. I think that's, a huge component of this, but it didn't start as a friendship, right? We cut the teeth of our relationship, so to speak, on business, on doing deals, chopping up deals, looking at deals, touring deals, all the component parts therein. And so I think, through that process, we came to really enjoy each other's company, but also understood that each of us provided something complementary to the other. And so that ability to kind of bring in and get this, buzzword synergistic, flow going with the three of us put together, we realized that we were greater than the sum of our parts when we were together.
So let's dive into this acquisition here so we don't delay too much further on this. I always am interested about the partnership side of things because I have my own thoughts on how partnerships should be run. And, it's funny because the way you're talking about partnerships is very similar to the way our group here at PassiveInvesting.com has set up our partnership as well, where really they're each person in the partnership knows what their lanes are and they stay within those lanes. Now, it doesn't mean that other person might not try to jump into the other lane sometimes, and you have to go, wait a minute, stay in your lane, right? Like this is where you thrive. This is where I thrive. And that doesn't mean we can't provide feedback back and forth, but it's, hey, this is my lane, right? So I think that's actually very good. That's one of the things that I think has been allowing us to have our partnership as long as it has been, and it has been as fruitful and successful as it has. So kudos to you for figuring that out as well, and having this long partnership. So talk to us about how you actually found and you sourced this deal.
Yeah. So, Dan, I had a hard time picking which one we wanted to talk about today, but I thought this was a great one for a couple of reasons that we'll get into. But the way that we found this deal is, one of our acquisition strategies is simply after we close a transaction to really kind of canvas the market, that sub-market, and see what other assets are close or available to us. And so, frankly, we had just got done closing a 426 unit acquisition in this same sub-market. And we said, hey, we really like Independence. We like the opportunity over here. And so we started to work on figuring out other assets that were in this sub-market. And frankly, I think a lot of folks look at deals that are listed and they just say, hey, they're going to write them off because they're listed. And we take a different approach. We say, hey, we're going to look at every single deal that's listed. We're going to make an offer on it and make sure those brokers know that, we're interested, but here we're at on our price. And so this was a listed deal. It's actually the tallest multifamily project in Independence. So it sticks out like a sore thumb, so to speak, and everybody knows about it. Well, it had been listed. We had made an offer on it. Our offer was not accepted. 3 or 4 months later down the road, we got a call back from the brokers and said, hey, it fell out of contract. Would you like to take another run at it? And we said, well, sure. But our price hasn't changed, and so we went through a long, arduous negotiation, I think, process with it, but finally got it under contract and we're able to get it closed. So, we really focus on, looking at that submarket after we close a transaction and trying to grow our footprint in that submarket.
I know you mentioned this being two separate assets, correct? That you guys purchased. Were both of them listed as basically on market deals, and you made an offer kind of on both of them, or was this being sold as a portfolio? Or kind of tell us about how that process.
Yeah, so it was definitely not listed together. And as we were touring, one of the times we were touring the 9th or 10th floors of the actual towers acquisition, I looked out the window with Parker and I said, hey, who owns that multifamily deal right there. And we realized there was about a 50 unit acquisition or, multifamily property right behind the towers. And we said, well, we need to find out who owns that and see if we can't get in front of them. And so we did just that. We found the owners and we were able to secure that project off market, while we were touring the Independence Towers project. So just looking out the window and saw another deal that we wanted to go purchase. So that was one off market property and one listed property. And it was kind of funny how we came across that second deal.
How many stories are these towers?
It's 10 stories.
10 stories. So each one of them are 10 stories?
Yes, there's one 10-story building that makes up 123 units, and then that's the Independence Towers. And Stoneybrook Apartments is 48 units, garden style, 3 stories tall.
Okay. Well, that's pretty unique. So which one was the one that got pushed to February 26th?
That'd be Independence Towers.
Okay, so the Towers one that you were going on, that was the on-market one, took longer than the one you guys looked out the window and said, we want to go buy that one.
Exactly.
We went under contract for the Independence Towers months before we went under contract for Stoneybrook. And we ended up closing Stoneybrook much faster than in the actual towers. And I'll let Parker speak to why, but the main reasoning being we were assuming a Fannie Mae loan on the Independence Towers project. But it's kind of funny, we didn't go under contract for Stoneybrook until after Independence, but we closed it way before.
Yeah, I think that was really it. It was the Fannie Mae loan. This is our first assumption loan that we had done before. It was a good loan product that we wanted to assume. It's 12 years, 4 years interest only, which we'd have 3 years up, 3.8% interest rate. We enjoyed it. The LTV was a really good LTV on this asset as well, and so we went through that process. And frankly, the seller had neglected to do some of the deferred maintenance items that were required by Fannie, and so there's this big negotiation about what to do there. There were cell towers on the building and leases that we had to dive into. And so a number of those factors just kind of extended out our due diligence. And frankly, dealing with agencies right now they're really backlogged. They have a lot of stuff to do and things are taking a longer amount of time. So it took longer, but we got it all worked out and eventually got it all to the finish line.
Did you have to put up any earnest money deposit on either one of these?
Yeah. So across, we had $69,000 earnest money hard on Independence Towers and $10,000 on Stoneybrook. So $79,000 in total.
Okay. And that was all in even after the DD period?
Correct.
Okay. And at what point during the entire process of this kind of acquisition did you initially tour the property?
So we had toured the property actually early on. So we toured these properties. Here's the timeline for you. So we toured the properties originally on June 12th of last year. Put an LOI out 10 days later. I didn't go under contract.
Felt like 10 years, didn't it?
Yeah. You bet. We went under contract in October, and then shortly thereafter went under contract on Stoneybrook, and then closed Stoneybrook on December 29th, which was fun to try to get in by the end of the year, and then eventually closed the towers on February 26th.
Okay. And let's kind of walk through the terms there of the LOI or the PSA that was finally negotiated. Was it a typical kind of 30-30-30 or kind of what was the timeline there?
Yeah. So the Stoneybrook was really, it was 45 and 15. So 45 DD, 15 days to close. We got all that done, in the time frame. The original contract on Independence Towers was actually 60 days DD with 2 30-day extensions. And then we negotiated an additional extension for the Fannie one.
And I'm assuming the seller understood that because obviously it was an assumption. So you never really know what Fannie is going to need or require. So if you need an extra 30, it's probably better to do that than try to find another buyer and then have them go through that whole process as well.
Yep, absolutely. And we released half the earnest money on deposit at that point in time to get that extra extension because we were very confident in the close.
Yeah. Yeah.
Dan, one note I wanted to make on that was, Parker and I were staying very close to the transaction, meaning, we were working through the broker, but we had multiple calls with the seller directly. So he knew our intent. He knew the kind of scenario that was going on with the COVID-19 regulations and some of the, the reasons we had to continue to extend, but we had access to the seller through the broker. And so we were able to actually build a relationship, whether that be a good relationship or not, it definitely wasn't terrible, but we actually had conversations with him, keeping him up to date and he had access to us, which I think helped the transaction process a lot.
Did you have any issues that came up on due diligence on either one of these?
So Stoneybrook was relatively clean. There were a few things that we kind of knew going in that we were going to have to fix, some deferred maintenance and items we had identified early on that were really a part of the process. When we had gotten through the, Independence Towers, there were a number of items that, seemed concerning to us. So it had an old boiler system, it had, a parking garage that had some structural issues and a number of those items. And so throughout that whole process, as we identified those, we did retrade, negotiate on some of those items. And, some of those items were items that the seller was supposed to have completed already. And so we assumed all of the capital that was in the account for doing those CapEx items to use for those CapEx items.
What was the final per door price on kind of both of those?
Yeah, so we were at $56,000 a door on the towers. And the Stoneybrook portion of that, we were at $41,000 a door.
Okay. And what's the business plan on this property?
Yeah, so what's interesting is, these two assets combined, Independence Towers is really kind of a core plus type asset. I mean, it doesn't need a whole lot after we fix these deferred maintenance items, which were already capitalized by the seller. There's really just kind of some unit turns that we're going to do. So we have about $4,000 a unit in the budget to renovate units more than a standard turn. And on Stoneybrook, we had some other items that we knew we were going to have to get into, some water heaters, and boilers, and all that kind of stuff. And so that spend is going to be about $7,000 per unit there. Effectively, one of the things that was important to us as we looked at this is, the rents were well below market, and we knew what the market was because we own half the comps in the comp set. And so we knew what we were getting on our other properties. And when you looked at, ones and studios being $100 below market and two beds being $60 below market, we knew we had the ability to go in there and push that. So we're going to make that spend, basically clean up units and then push those rents to market where our other properties are.
What's the current or before you guys took over the property, what was the current effective rents on both of these as well?
Yeah. So average across Stoneybrook, you had rents of $414, and those are for ones and two bedrooms. And so when you look at the comp set, you're looking at, $600 for studios, $700 for ones, $800 for twos. And so average for the towers is about $580. So we saw, immediately the ability to go push up rents anywhere from, frankly, $80 to $180 a month.
And how soon are you planning on doing that? After, obviously, you have now acquired both of these assets. What's kind of the timeline of that business plan of executing the renovations and getting the rents up?
Yeah, so we typically have about a 6 to 9 month plan on most of these kind of turns. 12 months for some of these assets. One of the things that we don't like to do, especially since the majority of what we work in is really the workforce housing space, it's not our goal to go in and kick people out of their homes, right? And so what we try to do is make these turns happen. Common area stuff that we can do, we do immediately. And then we make most of the upgrades on turns. We'd like to give people notice, heads up that we're going to be making these turns, a heads up of where rents are going to go, and give them time to plan. And so then we would go in and basically spend these monies. Some of the common area stuff will happen right now, like we're updating paint in the common areas, landscaping, a number of those things. And then we'll go and turn the units as they turn, just basically as the rents roll up.
Do you ever try to do renovations while they are living in the existing unit?
It's never. So the only time we've done that is if someone had an issue in their unit. So say there was a water issue or leaking drywall or something like that. We've gone in and said, hey, while we're in here, we're going to do X and Y and Z, and they're typically amenable to that.
So the typical plan is either to try to raise the rents while the resident is in there, or they can maybe move to a renovated unit, or they decide to leave because they don't want to pay that extra delta, and then you have a vacant unit that you could renovate and then rent out to somebody else that's willing to pay that extra premium.
Absolutely. And part of it too, right? When we look at the comp set, there's that delta that is just sort of in the market from a management delta. So that the management just hasn't pushed rents to where we think that they should be, even in their current condition. And then there's that sort of additional delta that we'll be able to achieve from improving those units. So kind of depending on the tenants, how long they've been in the building, what quality of tenant they are, we might, immediately achieve that delta just getting into the market in its current condition without going and pushing all the way. and then make those improvements later, or we'll try to move them into another unit. But again, our goal is not to necessarily go in there and kick folks out right away. It's to go in there and push, that NOI as soon as we can. And sometimes the best way to do that is to not have a huge CapEx spend.
So outside of renovations on the interior and the exterior, and also maybe some operational inefficiencies, where else would you say are you focusing on to try to, improve the NOI?
Yeah, I mean, I think, one of the biggest ways that we're doing that is through, it's through the rents, right? So when you look at the quality of the units, you have older carpet and cabinets and appliances and whatever. And so we can go in there and, pretty clean sweep. We have a standard kind of approach to, putting LVT in and painting walls and painting cabinets, updating hardware, updated countertops, appliances, updated bathroom fixtures, et cetera. And so that's a great way that we can go in and push that NOI. Additionally, one of the things that's pretty cool about having these two assets together is how we can expand upon the amenity spaces between the two. So Stoneybrook has a pool, but that's basically its only amenity. And Independence Towers has a fitness area, has kind of a party room, has some other items. And so we're actually going to be kind of cross collateralizing, so to speak, those amenities and allowing both buildings to use amenities at both places, which will increase, the overall experience for every resident.
Walk us through the financing on this deal.
Yeah. So, the Independence Towers was a Fannie Mae loan. So we assumed a $5.5 million Fannie Mae loan, great interest rate, long-term debt. And so our plan wasn't, to do a whole lot of CapEx. We actually capitalized all the CapEx for this property out of equity. On the Stoneybrook side of things, we closed that with a local lender that we have a really good relationship with. It always gives us really good terms, executes quickly for us. And we have just a very good relationship and had some very successful projects with. So we had about we were targeting a 75% LTC loan, rate about 4%. We ended up beating both of those. They were able to do a little bit more on the leverage side, as well as a little bit better rate. A year of interest only and 25-year AM. One thing that's interesting about that, right, is we have some additional cash from those additional loan proceeds. And so, we'll look at that and say, what does that look like on an LTV basis when we execute this plan? Because we want definitely some comfort. We don't want to be over leveraged on the long run. We have good debt service coverage ratios and all that. And so in a couple instances, they've been willing to give us more leverage, and we've said, no, we'll take it now, in terms of a paper contract, but we're going to pay down the loan and we don't want the additional debt service.
What kind of prepayment penalty are you getting on the Fannie assumption?
So it titrates down from 5 down to 1 over a 7-year span. And that's, pretty standard. The bank loan is a half point. There's a half point in, and there's actually no points out.
Okay. And so basically it's a step down prepay for the Fannie. It actually steps down to 0 after 7 years. And you said there was a 4-year IO, but there was 3 years left when you assumed it. What kind of interest rate did you assume on that one?
3.8%.
So still pretty competitive there.
Mm-hmm.
And 1-year IO on the local bank financing for the Stoneybrook. Okay.
Yep.
Good. And how did you structure this deal with your investors? So kind of like how much were you looking to, raise and how did you structure with the investors that were in this deal?
Yeah. So we, first off, we structured this as one. We had sort of a holding company that we fundraised into. And so this deal we have a kind of holding company called Stoneybrook Towers LLC. That owns both of these underlying assets. And so all the investors get kind of the benefits of sort of this core plus cash flow, because we walked into 11% cash on cash in towers, plus this value add strategy over on the Stoneybrook side of things. And so that's going to have a little bit higher yield overall. And we're going to blend in, we're kind of projecting high teens IRRs for both of these assets combined. Logan, you want to talk a little bit about the fundraise side?
Yeah, sure. So this was an interesting fundraise for us, only because we tried the 2-tier worth of investment class. So we had the opportunity, if somebody was going to invest over $200,000 with us, they had a 9% preferred return, and it was a typical $100,000 or $50,000 investment. It was our typical 8% preferred return, and we just do a pretty simple model after that. It's 70% to our limited partners and 30% to the general partners. And so, we had 2 or 3, I think, investors take advantage of the $200,000 step up. Legally, I'm not sure how much trouble that caused Parker on working with our SEC attorney on that. But, I think the investors that did take advantage of it were very happy about the step up on the preferred return side of things.
Yeah, I think and this is just giving you my opinion, I think where the difference is when there's not that much of a delta between the 8% and the 9%, it's not as appealing to the investors, right? Obviously, if you fully understand the capital stack structure, I'm assuming that the 9% was also a preferential treatment in the capital stack as well, correct?
Correct.
Yeah. So obviously you're giving up a portion of the upside to be able to have that I call it as close to a guarantee as possible, even though we all know it's not a guaranteed 9%, but it's as close to that guarantee as possible. So I think we've actually had that discussion internally with our group about, if we always do a 7% preferred return, and we have that now there's a 200 basis spread versus 100 basis spread between, that 9% and the preferred return that we have for the Class B and B investors. And we usually fill up on Class A. Like we have most of the time we have over subscriptions on that Class A. I think part of it's because we have, a little bit more of a delta between, the 8 and the 9%, if you will. Ours is kind of the 7 to 9%. And I know some groups that actually have seen doing an 8% and 7%. So you do an 8% Class A and a 7% Class B. And then I've seen some that do a 10% Class A and they still have their typicals, kind of 7 or 8% on Class B. But the biggest nuance that people have to understand, and this is something that we've tried to educate our investors on, which I think probably is what has allowed us to be able to raise more money in that class, is that if you understand where your position is in the capital stack, it's actually a really great position to be in. I mean, to know that you're pretty much protected no matter what happens to that asset, not really no matter what happens to it, but unless like the entire, asset completely goes to pot, I mean, you're pretty much protected with your initial investment plus pretty much a guaranteed, even though we know it's not, as pretty much a guaranteed 9%. And if you run the numbers of actually taking that 9% and if you can reinvest it in the same month or quarter that you get it, you can now compound that 9%. And many times, depending on the investments that you're getting in, you can have a nice blended return, which is similar to what a lot of investments are when you're in a higher risk position in that Class B position. But you just have to be able to be more diligent about reinvesting those proceeds every single month or quarter so that you can actually increase those returns, and then it reduces the overall risk of the entire portfolio.
Yeah, absolutely. I know that we're definitely on your email list, and you do a lot of work on the capital stack and the education piece on that. So we take a lot of notes from the information that you're putting out, and we started to roll out our own monthly investor webinar series, just trying to educate folks on that. So I think that's a great point. I think we just wanted to test kind of to see what type of investors were interested in that, but maybe having a bigger delta on that next time will give us a little bit more spread, and investors will see the opportunity there.
Yeah, I definitely think having a bigger spread would help, and then also just being sure to educate those investors up front, because when we first started doing that dual tiered structure, we didn't see as much demand until after we started to educate the investors and they actually fully understanding that structure. Because it's and we try to explain to the investors that when you're looking at this on other operators, here's some additional things to be looking out for, making sure that you are preferred. I've actually done some investments in the Class A structures inside of these inside of the dual tiered structure, and I have decided not to do them in some of them because of how they do it. As a matter of fact, before you were on here, I was talking to our investor relations person that actually talks to all of our investors now, and he had a question just today about on one of our PPMs that we're raising money for right now, inside of the kind of refinance waterfall, if you will. Normally, in a exit waterfall, like when we actually sell the asset, you're going to give all the money back, the capital back to the Class A first, and then you would give it back to Class B, right? That's where that preferential treatment is. And that's great. That's how our PPM is listed. But inside of the refinance waterfall, it's not listed that way. They don't get preference. And the reason why is because in that refinance waterfall, the investor, Class A investor, if they get paid back first, then they basically get no more money after that because their preferred return is based off of the unreturned capital contributions. So in a refinance waterfall, it's always going to be a 50-50 share so that you can still have those Class A investors be still benefiting from the property. Now, it benefits the property more if we can get those investors out, right? Because we're having lower cash flows that we have to distribute, but we're trying to also protect our investors and their investments and stuff like that too. And so being able to understand some of those different nuances are great things to educate to the investors. Let's pivot here a little bit. I know we're talking about capital stack structures, and I enjoy those conversations. This is a lot of fun. I look through those kind of deals all the time from different people. But how did you end up going and raising this capital? Like, how much work did you raise, and how long did it take, and kind of what was the process there?
Yeah, so our typical structure, I think, is very similar to many syndicators out there. We'll invite our investor group or club, if you will, to a webinar. We'll go through the project and answer questions and then have follow-up calls. I mean, and thankfully we've been kind of building this network up for quite some time now. It's been 7 years for me here in Kansas City, just talking to people and keeping a good Rolodex. And so we've got a decent amount of investors that show up to these webinars, and based on their basic investing goals, then I'll kind of tell them, I have a pretty good relationship with most of these guys or gals, and I'm saying, hey, I think this is a great opportunity for you, or hey, based on what we've talked about, you should probably wait for the next one. I never like turning capital away necessarily, but whenever you take that approach and you're really looking out for somebody, they start to trust you a little bit more. So we did our webinar. Frankly, Parker, I don't know if you remember how many investors we actually brought into the deal. I believe it was between 25 and 35 investors into the project. And we raised that capital in about 3 weeks. And so Parker's got probably the final number that we had to invest on this deal, but it takes us usually 2 to 3 weeks to get these things done, and that's just because every investor has certain questions around the PPM and subscription agreements and things like that.
Yeah, so we raised 2.8, just under 2.8 million.
Okay, 2.8. That was for both sides.
Mm-hmm. Correct.
Okay, good. Can you think of anything else that we have not touched on yet that might be interesting for us to kind of dive into a little bit, that might be good for our listeners to learn about on these acquisitions?
Yeah, I'll jump in there and let Parker kind of play off what I say. But, I think that when you're going into a new acquisition type, meaning this was our first 10-story, building that we were purchasing, there's different due diligence items. There's a boiler that has to get hot water up to the 10th floor. There's an elevator. There's, they had covered parking, a garage at this property. That took a lot of different type of due diligence checklist items that we had to kind of create and go through. So that was one big, learning lesson for us, is just, our typical due diligence checklist for a garden style multifamily apartment complex did not apply here. And there were things that we needed to go through that we didn't necessarily have to in the past. And the second being, when you're going through an assumption process for the first time, even if the agency tells you, hey, we'll get this done by the end of the year, you really need to have some padding in that, especially during COVID, some opportunity to be able to extend and make sure that the seller knows your intention and have a game plan for when things don't go as planned, because we had to have plan B, and then we had to have plan C, and then we had to go back and create plan D on this project. That's why we had to push this recording back so many times. So really making sure you have specific due diligence items that you're going through for that asset. And then also when you're going through any type of assumption process, especially at the end of the year, when everybody's trying to get something done, you probably need to have some padding in there. Parker, do you have anything to add to that?
Yeah, I mean, I'd say one of the things is, like you mentioned, and this asset being, similar but different to a lot of our assets, being that this is a high rise and most of our assets are garden style. I think one of the troubles or difficulties became when you evaluate that, and you say, well, how do we evaluate the comp set? I mean, this was higher price per door than the entirety of the comp set. And the delta was about, 10% higher. It wasn't a huge number, but we were kind of evaluating that and saying, why and what can we do there, et cetera. And so you have to think about, high rise offers, some different things in garden style in terms of views and all of that throughout the building. And so that was just a real key component that we had to do in evaluating the rent comps and the sale comps, is how does this really compare to these other assets? Now, we're pleased to say that a number of assets have actually sold or gone under contract since we bought this at, 15 to 20% higher numbers than we bought this asset for. But that was still something that we had to kind of wrap our head around early.
So I have two final questions as we're wrapping up the episode here. I'm going to direct one of them to Logan, and I'm going to direct the other one to Parker. Okay. So this first one's to you, Logan. What did you find that was easiest during this entire process that maybe originally you thought was going to be a little bit more challenging?
Getting folks on board with kind of a blended strategy, right? I was really concerned with having a nice cash flowing asset with less value add, and then blending that with a heavier value asset that's not necessarily cash flowing as strong. And so crafting the narrative and telling our investors, the opportunity that we have here, I was very concerned about, and I was really curious to see how it would be received. But I think that we showcased the fact that having both of those strategies implemented into one project really mitigated some risk. So that actually went really well with our investors, and it turned out to be a plus, not a minus in the scenario.
And Parker, yours is kind of the opposite of that. So what did you find was harder that was originally you thought was going to be a little bit easier?
Yeah, I think, the due diligence that we talked about, right? I think we walked in thinking that we were going to be able to kind of do normal due diligence and hadn't thought about some of the things like, the water and whatever else, right? We were looking at this, and there's, a single boiler feeding water 10 floors, and, there's some calcification on the first floor. And we said, oh, do we have an issue? And it was, is this issue on the 10th floor? And so then we had to go cut into walls and see what's behind the walls up there. And ended up being okay, but just things like that we hadn't necessarily, been aware of, that we found out during this process, and now have the benefit of that knowledge going forward.
Great. Well, Parker, Logan, thank you so much for spending some time with us here today and sharing with us all the details and the golden nuggets around this acquisition. How can the listeners reach out to you if they have further questions for you, maybe about this acquisition, or maybe they want to join you on some of your future acquisitions?
Well, I appreciate that, Dan. Our website is ftwinvestmentsllc.com. And like any good website, there's plenty of ways to contact us, and we've got a lot of great resources on there. And so that's the best way to get a hold of us. Parker and I are both very active on LinkedIn as well. And we'd love to connect with anybody who wants to learn about the Kansas City market.
Awesome. Well, thank you both so much again for being here and sharing all this information. Looking forward to continuing to follow you as you close more deals here in 2021, and looking forward to having you back on a future episode.
Thanks for having us, Dan.
All right. Thank you so much.